Before starting this lecture, I hope you better understand about trends and the trend series. We discuss in detail the trends are in three forms: uptrend, downtrend and sideways trend. Now we discuss trend line and channels in detail. What is a trend line? A single trend line can be applied to a chart to give a clear picture of the trend. Trend line can apply to highs and the lows to create a channel. It means if the highs and the lows are in a symmetrical form or in an equal form, then it creates a channel. The time period being analyzed and the exact point used to create a trend line vary from trader to trader. It means the two successive bottoms or two successive tops may be subjective matter for trader to trader. Most of the people ask from me why we use a trend line if we already follow a trend series. Then my answer is the trend line is among the most important tool and which give you an early prediction of trend reversal. It means the trend line, if the price break the trend line, then we clearly symptomize that the trend is reverse. At the time of price break the trend line, the trend series is not reversed. It means prior the trend series change, we identify the change in trend through trend line. A trend line helps technical analysts to determine the current direction of market prices. Technical analysts look for trend price or trend lines in price action. Technical analyst believes that the trend line is your friend and identify this trend line is the first step in the process of making a good trade. That means before getting a conclusion on any stock, you must draw a valid trend line. The most important part is how to draw a trend line. Before draw any trend line, you must ascertain the two successive higher bottoms or lower tops to consider which start from absolute bottom or top. It means if I want to get two successive bottoms or tops, we always start finding that successive bottom or tops from absolute top or absolute bottoms. To create a trend line, an analyst must have at least 2 points on a price chart. Trend line connects successive two higher bottoms, then it is called as uptrend line, and trend line which connects successive two lower tops, then it is called as downtrend line. We understand trend line in simple form by taking a chart example. As the chart show on your screen, we clearly signifies that if we connect the lower highs or consecutive or successive lower highs, it is signified by a red line. That red line is called as downtrend line. And you also see a horizontal red lines which clearly signifies that trend series will be in downtrend. On the another side, you see a green horizontal line which clearly shows a trend is uptrend, and if we connect these successive bottoms, then it is considered to be a uptrend line. I hope with this example you clearly understand the importance of uptrend line and downtrend line. Keep in mind these both trend lines, the red one and the green one, is also considered to be a good support and good resistance. The downtrend line become a good resistance and the green trend line, uptrend line will be a good support. We also see after the breaking of green uptrend line, the price is sharply downwards, or if the price is close above the red trend line, then the price is move upward sharply. It means trend line breakout is very important symptom of trend reversal for the traders. When we discuss limitation of a trend line in detail, all charting tools or trend line are readjusted as the more price data come into the picture. That means for a daily chart, the trend line is drawn, points are different than an intraday chart. Traders often choose different data points to connect. That is also a subjective matter while we drawing a trend line. Trend line applied to small time frames can be a volume sensitive. A trend line formed on low volumes may easily be broken as the volume pick up throughout a session. Now we understand what is a channel. A channel is a chart pattern that connects a stock price peaks and throws over a period of time. In a simple language, if the peaks and throw are in a symmetric and if we connect bottoms and tops similarly or simultaneously, then it is considered to be a channel. Price channels are useful tool for stock analysis. They require at least 4 points to connect, 2 each for upper point and 2 for lower points. Price channels can move either upward, then we call as upward channel. If they move on downwards, we call as downward channel. And if they are flat or horizontal, we consider to be a parallel channel. Investors or the traders use the channel as a strong form of price movement which stay in trend for long time. If a stock is fluctuating between consistent high and lows, a trader use that channel to predict price peaks and price throws in advance. For example, if a trader buy a stock when the price touches the lower channel, then is easily set a profit target at the upper channel line. We understand the channel in a simple language or in a simple form by the help of an example. As the sample chart show on your screen, you easily see that by the help of lines we connect and we create a channels. In the first part of the chart, the two parallel blue lines which connect the bottoms and tops simultaneously will create a uptrend or up channel. After that, once the price break that channel, the price move between the lower tops and lower bottoms that connects with the or signifies with the red lines. The two parallel red lines create a downward channel. At the absolute end of the chart, you see a horizontal lines which connect the same top and same bottoms, which is called as sideways channel or we call as parallel channel. So by the help of this chart, you clearly identify the upward channel or downward channel or maybe a sideways channel. I hope you better understand the channels and trend line in this lecture.